Good morning, everybody. I'm going to give everyone a little bit of time to get logged in today. Good morning, everyone. Thank you for joining us today. If you think the current state of the economy feels like an avalanche waiting to happen, you're not alone. Navigating market volatility at any point in your investment journey can feel uncertain, unsafe, and isolating. This Q&A, hosted by Kaci Skidgel and Peter Reardon, will discuss the current state of the economy and asset markets. We'll explore topics like inflation, interest rates, recession, and the market outlook, and any questions you have for our team. We do have the Q&A feature available, so you can submit questions through that option. And if there is time at the end of this session, those questions will get addressed. You can also submit any questions to us via email at marketing@yoursummit.com, and I will display that email address again near the end of our session today. So let's get started. We have two speakers joining us today. Our first speaker is Peter Reardon. Peter is an investment advisor representative and serves as an analyst at Summit. As a graduate of the University of Tulsa with a degree in economics and finance, Peter focuses on researching investments in capital markets with the goal of providing the best-in-class investment monitoring and recommendations. Peter researches and informs clients on key topics in the global economy and uses that information to analyze fund data from both a quantitative and qualitative perspective. His process-driven approach allows him to go beyond surface-level data and understand the underlying issues that drive investment performance. His knowledge of securities and the retirement plan landscape allows him to develop strategies that are best for your business. Our second speaker is Kaci Skidgel. Kaci serves as Summit's president and oversees Summit's investments division. She has been named by NAPA as one of the top women advisors for 6 consecutive years, and more recently named a top retirement plan advisor by Plan Advisor magazine in 2022, and Financial Times top advisor in 2018. Kaci is the chairperson of Cetera Advisors Retirement Plan Advisory Council, and she also authored the book Path to the Summit. Her team has been named a top DC advisor team in 2020 and 2021. So now I'm going to pass it off to Kaci to get us started today.
Well, thank you, Riley, and thank you to everyone who has joined us today for Finding Your Footing. At Summit, as an organization who is focused on benefits, risk management, insurance, and investments, we really believe that it is important for us to bring you timely information that is both relatable and understandable. And it is my hope that with all of the noise and all of the challenges of the market, you will gain some insights into how to better review your personal situation. We know it's been a tough year for portfolios, so Peter is going to give you some context into those declines, and more importantly, provide some reassurance for the future. And isn't that what life's all about? The market's up, the market's down, we're in this inflationary period. I hope at the conclusion of the webinar, you're going to be able to answer the question, what do I need to know today for my financial future? And I'd be remiss if I didn't say thank you to all of our retirement plan clients, all of our personal clients who have taken the time to join us today. We appreciate you committing the 30 minutes of time. If you know someone who should have listened in today, please be aware that we are recording this, and we're happy to pass that information along to others. We understand that everyone's situation is unique, so we want to address that appropriately. You see, with each generation, every time a generation faces a share of its own challenges, and at times it can seem quite overwhelming. Today, there is no question that we are faced with some daunting headlines and unknowns, but we should also consider what we as Americans have been through over the last century. Since 1900, we've seen a global depression, 2 world wars. Maybe you personally remember the assassination of JFK, or remember the pictures of 9/11. But as Americans, we have overcome military conflicts, oil embargoes, the Great Recession of 2008, and that's just the tip of the iceberg. Despite all of these challenging times, difficult events, our US stock market over time has continued to climb. I think I need to repeat that for some of you. The market has actually increased over time, and that's because of you. That's because of the resiliency of humans and our resiliency to overcome challenges. So investors who remain patient and courageous over time you are rewarded. That being said, we know that there's a lot of questions where the market stands right now, how we should view it going forward, and what we can do to appropriately position ourselves. I'm joined with Peter Reardon, an analyst here at Summit, and we do want to keep this more informal and conversational. So Peter, let's jump in with the first Q&A. A lot of individuals have seen their account balances drop in 2022. Can you please explain why we've seen these asset markets struggle so much? And then help, because we keep getting this question from plan participants. Is it across the board? Is everyone's portfolio down this year, or is it just isolated to certain clients of ours?
Yeah, well, first off, thank you, Kaci, so much for the introduction and the opportunity to be on and help try to give some context to the investing landscape right now. To address the latter question first, absolutely. I want everyone to understand that if you see negative numbers in your account this year, whether it be a 401k, IRA, brokerage account, etc., you are not alone. Most everyone in the marketplace is experiencing something very similar. This year has been challenging for everyone, from younger investors just getting in the workforce to older investors getting ready to throw that retirement party. Essentially, there's been nowhere to hide from market volatility. In fact, over 90% of all asset classes have lost money so far this year, meaning that of all the investment categories you could find, stocks wherein you buy ownership of a company, bonds in which you'll receive interest payments, mutual funds, which you'll find in retirement plans holding large amounts of different stocks and bonds, or even target date funds, which invest in stocks and bonds and will make your investment allocation more conservative as you approach retirement. Over 90% of those categories are negative this year, which is the most since 2008.
So Peter, let me just jump in here real quick. What I just heard you say, that not one person on this call is protected from the volatility overall. Sort of like we're all in this together. Every account has been hit, and there really isn't a safety net per se in any of the funds, like nowhere. Is that accurate?
It is. And for example, my personal portfolio is down somewhere around 20% year to date. My 88-year-old grandmother's portfolio is down almost 15% year to date. So it's been a challenging year almost no matter where you look. And I do think that's important to know. As for why the asset markets have struggled so much, there are a lot of different directions you can take that question. But from a broad perspective, it's uncertainty, and more specifically, uncertainty in three areas: inflation, interest rates, and recession. Those are three major concerns for individuals and corporations, as we have inflation at over 8%, interest rates rising at the fastest pace we've seen in a long time, and a stalling out of economic growth. Those are three key factors making the asset markets jumpy and causing them to drop.
So Peter, from that perspective, unpack it just a bit more. You mentioned almost all asset classes have gone down so far this year, including both if you're in mutual funds, stocks versus bonds. Can you explain why? And I know this is a question that I keep hearing from employers as well as plan participants. Why would both of those asset classes be struggling when typically we think of bonds doing well if stocks are doing poorly and vice versa?
Yeah, so this is an incredibly important question, and so true that we sometimes fall into the trap of thinking stocks and bonds will be negatively correlated, but that's not always the case by any means. This year, the S&P 500, it's down roughly 20% year to date. The total bond market, on the other hand, is down roughly 16% year to date. So while yes, bonds have provided a bit of a hedge to stocks, even if you have a relatively conservative 60-40 portfolio, you're down well over 15% so far this year, which can give you a bit of a shock. And there are a few things we need to observe first about the stock market, then the bond market, to fully understand this phenomenon of both stocks and bonds being down so much. With stocks, one thing to remember is that going into 2022, stocks were arguably very overpriced. Going into 2022, we were coming off one of the best 3-year runs in US stock market history, where they were giving you an average 20% annual return in 2019 through 2021. So we need to understand that stocks have been on this great run prior to this year, and they had priced in a lot of optimism. Immediately, there were a few events that hurt that optimism in the beginning of 2022. The Russia-Ukraine war, higher interest rates, and inflation. Investors were and are worried about how these events may affect their investment supply chains, their input prices, their future cost of debt, and overall profitability. That leads investors to sell their stock positions thinking, oh, well, maybe my stock isn't quite as valuable as I thought it was going into this year with all this new information that I have.
So Peter, what I'm hearing is that stocks overall have struggled because of the combination of events like Russia, Ukraine, overall environment of uncertainty in the economy. And it also sounds like that optimism that we had continued to experience over time has been replaced with realism. One thing that's really apparent to me when I think about this, I feel like people sometimes have amnesia about the fact that you could lose money if you are investing in the stock market. And I am not trying to scare anyone. That's not the goal of today. I just want to remind all of our clients, all of the plan participants, all of our plan sponsors, that when you invest, the market does go up and it does go down. But what is important to remind you that we have literally finished 12 years of an up market. And I know that the younger generation, I think of my 24-year-old son, my two 25-year-old boys, they have never experienced anything but positive returns. And they kept seeing their accounts increase over the last couple of years as they've entered the workforce. Until this year, they had never experienced getting that quarterly statement and seeing a negative return. So all of a sudden this year, they're shocked that they're putting money into an IRA as well as into their 401k plan, but they're actually down. And so I want to remind everyone that's on the call today, you actually do not lose money unless you sell out or cash out. If you stay invested, while you may see a lower account balance, as long as you don't get out or close out of that account, you actually only experience a temporary decline. So, and I think of this because as a female, I love a good sale. If there are any other, I know that there are women on this call, you like a sale, whether it's on purses or shoes. Some of us, it's that BOGO, buy one, get one free. It's some type of discount. We love a good sale. But I feel like at times, sometimes we're actually forgetting that you can experience this sale. And I hope you will hear me that right now, I believe that the stock market is on sale. If you're in a retirement plan, if you're contributing to an IRA and you're putting in money on a regular basis, think of this as Black Friday right after Thanksgiving. Why would you want to buy something for $100 when you can get it for $80? Effectively, that is what is happening. Each time you put into your 401k plan, each paycheck, use what's called dollar cost averaging. So now is a good time to buy for a sale price. Now, Peter, I may have just gone on a little bit of a rant there, and I get it. I'm pretty passionate about these kinds of things, but I was around in the 2008, 2009 time period. And I remember the Dow Jones being down at 6,000, having lost more than 54% of its value. And since then, we saw it climb again. So younger investors, you should think of the sale. But I do want to shift a little bit, Peter, because I know that we have people of all ages on here, and I think of those people who are getting closer to retirement. Maybe you thought you were going to retire this December. Maybe you marked your calendar and you said, on my 65th birthday, that's it for me. I'm done. I'm retiring. Peter, let's make sure that we also address those people who are getting close to retirement because they don't have the benefit of continuing to put in money potentially for the next 5 to 7 years. In fact, I know that in general, we talk about bonds being a better protector typically of downside. And even we at Summit normally see our more mature investors and those who are either in retirement or about to retire have a little bit heavier allocation typically toward bonds and less in stocks. So tell me what's causing the challenges in the bond market.
Yeah, no, I think those were all great points, Kaci. With the bond market specifically, we have to look at inflation and interest rates as the main culprit. You see, when we get high inflation, the Federal Reserve steps in to try and bring it down. The Federal Reserve, or Fed for short, is the central bank in the US that supervises and regulates banks and is in charge of keeping the overall financial system safe and stable. And so the Federal Reserve cools off inflation by raising the short-term interest rate called the Fed funds rate, and that ultimately trickles into other rates set in the marketplace, like mortgage rates, for example, which actually topped 7% this morning. So the Federal Reserve raises rates. That makes the general cost of borrowing in the economy higher and slows demand. That slowing of demand is what allows inflation to go down. Now, how that relates to the bond market, when rates go up in the marketplace, the value of your current bonds goes down. Reason being that as new bonds are issued with higher rates, the value of your bond with that lower rate is going to go down because those new bonds will pay more interest. So to put this in context, if we go back to the pandemic, first quarter of 2020, the last time we saw a huge downturn in the stock market, S&P 500 was down over 20%, but the bond market as a whole was actually up about 3% and acted much more like a true safety net because rates were going lower. Inflation wasn't a concern at all, and the Federal Reserve wanted to stimulate the economy, so they slashed rates. Fast forward back to 2022, the stock market, it is struggling. There is economic worry, but the Federal Reserve has chosen to raise rates to fight inflation, which hurts the bond market. So the bond and stock market won't always zig when the other zags, and sadly, this is one of those times.
So Peter, I want to get your thoughts on where you see some of these issues that we just talked about. But first, pivot for just a moment. We do have the midterm elections because we're starting to hear from some of our clients calling and saying, hey, midterms are coming up. I don't know if I should just run to cash. Can you give us some insight on how we should view investing as election season approaches? I know that at times I hear people wanting to move their money based on their beliefs about what's about to happen. Should we be factoring that in?
Yeah, absolutely. It's a tough question, of course, because elections matter. The people we elect to represent us matter, and the policies that are instituted are important. But I'm going to give the classic yet very true advice on investing through election season. Don't let your emotion affect your investing. Right now, we're either headed towards divided government or more single party rule. From what we're seeing and hearing, a divided government tends to look more likely. But as we know, it's hard to predict how election day actually plays out. A divided government can be good for markets because it can reduce the risk of markets being surprised by major legislation. That being said, we've seen plenty of examples of the stock market doing well with just one party in control. And I want to remind everyone that historically, markets have gone up and down with both parties in control. And if you decided to just invest when either your party controlled the White House or Congress, your investment returns would be significantly negatively impacted over time. So the advice is straightforward. Don't make rash decisions to your investment planning based off the election. Yes, elections matter, but historically, you don't want to base your long-term investment decisions off them. Now, I wouldn't be surprised if we see some market volatility persist. Midterm election years are historically choppy, but I would impress upon everyone that even if markets do react in the short term to elections, there's so many variables that determine economic growth, profitability, and overall market returns. In fact, if we look at the period of time from when FDR was elected in the early 1930s through 2019, there were 7 Democratic presidents and 7 Republican presidents. There had been divided governments and one-party control governments. And throughout that time, if you invested $1,000 in 1933, it would be worth $14 million through the end of 2019. So all that being said, historically, you don't want to determine your investment strategy just based off what party is in control.
Well, Peter, that's a pretty staggering statistic. Wishing that my grandparents, great-grandparents had $1,000 to invest in 1933 with all the wars and coming out of the Great Depression that you referenced, and it would be worth 14 million now. But what I hear you saying in all reality is, do not let our emotions determine our investment strategy. Don't get emotional in the next couple of weeks, but try to be patient, try to write it out. For Kaci, I hope some of you will resonate with this saying. There's a quote by Warren Buffett, and it really encapsulates it for me. And it's one of the strategies that I personally use. Warren Buffett says, be fearful when others are greedy, and be greedy when others are fearful. And Peter, I know you've used that exact same saying, that we've talked about that quite a bit. So that's just food for thought for some of you. Kind of shifting here, thinking about the underlying factors that you mentioned. You mentioned interest rates, inflation. Where do you see these going forward? And I know that everyone that we talk to is asking about recession. So if you'll address that as well.
Yeah, well, sadly, I don't have a crystal ball. I wish I did, but I can certainly try to take a shot at it. So let's start with inflation, because I think that is really a major concern. And I think two things can be true on inflation. It can continue to be an issue, yet it can improve. I think there's a lot of factors with respect to the outlook on inflation. Number one, the rate hikes that we've seen are going to increasingly kick in as we move into 2023. The policy of the Federal Reserve works with long and variable lags. And so it really hasn't kicked in yet. And we're going to increasingly see that. That can help to bring inflation down. I'll quickly note as well that we will see more rate hikes this year and potentially into next year as well, before interest rates do level off and possibly go down from there. That's really the gist on rates. Additionally, with inflation, there are also some more short-term aspects of inflation that are likely a result of geopolitical and pandemic-related challenges, and hopefully those will begin to wane, like grocery and food prices, for example. But there is some inflation that's getting more entrenched in the economy. Rent and wage growth would likely be examples of this, and these are still well above target level. So I tend to think that we'll begin to see inflation turn over and move in the right direction. I know you've heard that from market experts for a while, and they've been wrong. Cough, cough at the Federal Reserve, but I do think it will come down. It's just going to happen slowly, maybe down to 5% next year, and then maybe to 3% the next. And so we do need to be prepared to continue to see inflation elevated above what we've been used to over the past decade and really beyond. Another quick basic reminder on inflation, as we do hopefully begin to see it come down, it doesn't, if inflation comes down, that doesn't mean goods and services will get less expensive. It just means they'll get more expensive at a slower rate. And then moving on to think about the all-important R word, and will we see recession? I think the risk is uncomfortably high. And we've already seen economic growth slow significantly in different parts of the economy, such as housing, spending, et cetera. They're increasingly showing we might be headed towards recession. Technically, we are not in recession right now. One thing we can point to as for why we aren't is because low unemployment rate, low jobless claims, and high number of job openings, which all look good. Plus, we did get a positive GDP number today. However, I do think the risk of recession is uncomfortably high because of the way economic growth is slowed and because of the financial conditions tightening. But if we do go into recession, that doesn't necessarily mean it will be severe or long lasting. And I think that's important to remember.
So Peter, I understand what you're saying just from an overarching perspective for me, but I think of my 92-year-old grandmother who lives with my cousin, her family. She is on a fixed budget. She has home health care during the day, but she knows right now what her budget is. And every month she knows what her expenses are for the most part. But as inflation hits, she has no way to increase her monthly budget. And I know we have people that are on the call today that are in that same boat. So we've got the cost of groceries, prescription, I think of her doctor's appointments. All those things are starting to impact her with inflation. With other family members having probably the same challenges with our clients, just sounds like it's a mixed bag with respect to our future outlook over the coming months. So considering this uncertainty, how should we actually think about investing with all of the volatility happening?
Well, as someone who is younger and believes in the resiliency of the markets and the resiliency of corporations to be profitable over the long term, I would encourage everyone to stay the course and treat this as an opportunity. If we break that down a bit, starting with the stock market, try to think of it as a sale. As you mentioned, Kaci, when your favorite items, clothes, technology, entertainment, when they go on sale, you naturally jump to buy them. I'd try to think about stocks and investing the same way. Now, could stocks move further down over the near term? Absolutely. I would argue that's likely. But I think stocks have reached the point where they're actually potentially overvalued. And if you're worried about investing because of recession, the thing I would caution about that is stock markets are leading economic indicators, meaning that they're going to drop before the economy actually does, and they'll usually begin to rebound before the economy actually does.
And Peter, when we were going through this and practicing before and talking through this, I want you to repeat that one more time, because I really do think that everyone should hear this one more time.
Yeah, absolutely. Stock markets are leading economic indicators. They will drop before the economy actually does, and they will usually rebound before the economy actually does. And I'll add on to that, that's why it's so hard to market time and get in at the perfect moment, because you never know when the stock market is actually bottomed out. So as long as you can stomach some shorter term volatility, I would take advantage of the discounted stock prices and begin to slowly get back into investing into stock funds. And if you never sold out, I certainly wouldn't now. For bond funds, it's understandable why bond investors would be even more frustrated than stock investors right now. But I do, in fact, think the bond market is looking relatively attractive. With the way rates have gone up, it makes for a better entry point for bonds to go ahead and lock in that higher rate. And I think it's possible we've already absorbed a lot of the upward movement in rates. Plus, if we were to go into recession, the Federal Reserve might have to pivot and cut rates within the next couple of years, which would, of course, help your bond holdings. So I think bond funds actually, they might continue to experience some short-term volatility, but over the longer term, I do think that they're looking relatively attractive. Of course, we're in unique times, and inflation can really throw a wrench into all this. And so even though I do believe market volatility will persist over the short term, we haven't seen the end of the downturn. I do believe there is opportunity in the stock market and the bond market for the patient investor.
So the principle of courage is absolutely important in times when we're experiencing this volatility, to be able to weather that storm, to see opportunity in the midst of it. Finally, Peter, we know it isn't always as straightforward as just investing. So I always like to give people a couple of tips and tricks. So what tips would you have for investors to navigate during the current conditions?
Yeah, agreed. I think that there's two big ones that come to mind. Number one would be to make sure you're properly diversified. It's more important now than ever. That sounds strange, considering I essentially just told you everything has been down. And yes, that's true, but everything has not necessarily been down by the same amount. Through the end of the third quarter of this year, the growth stocks, which are your more highly levered, more debt-oriented innovation companies like Tesla, they're down over 30% as a whole. While the value stocks, which are your more historically established dividend payers like Coca-Cola, they're only down about 18% as a whole. The same goes for internationals versus US, smaller companies versus larger ones. Sometimes we see individuals look at the different investment options and just pick the one that's returned to the best over the past 3, 5, or 10 years and put all their money there. That's really not what we want to see. Market conditions change, and ensuring you're properly diversified can really help. Number two, I think it's important to recognize your risk tolerance in times of volatility. If the market's keeping you up at night, maybe you do need to be a bit more cautious in how you're invested. I think there's opportunity out there, but that doesn't mean you should completely ignore your feelings and instincts. Your mental health and comfort is an important part of this as well. And I think that's a good segue to say, consult a financial advisor if you need to. We at Summit, we're here to help. I can understand how some of you may be thinking it's easy for me to say, stay invested when I have 30 plus years until retirement, and that's fair. For those of you close to retirement, it's been a challenge. And as I mentioned, even a conservative portfolio has really taken a hit, and the future can feel increasingly uncertain. So if you need help planning, please reach out, and we have members of our team who are more than happy to help.
And that is great advice, Peter. I mean, your personal situation for each of you that's on today, your personal situation is really your situation, and emotional well-being is important. We know that stress and anxiety about financial matters, it's actually a part of the situation. So we actually have a quick little quiz that we can use to help you assess where you are today. If you want to reach out, or if you just want to type it in the chat, quiz or risk quiz, either one of those, we can actually email a copy of that to you, and that could be a follow-up for you. It helps you to kind of assess, benchmark what you're feeling today. This can help you to navigate during this time. And all it takes is one phone call, one quick little quiz. My other advice, I feel like with that 12-year run in the market, people really forget this, but I recommend it. Look at your personal portfolio annually and make sure you're in alignment with it. When was the last time that you sat down with an advisor, discussed your investments as a whole with relationship to your situation? If you're married along with your spouse, we take an unbiased and objective approach to assisting you, and we'd be happy to talk to you about your personal situation. At Summit, our licensed professionals are here to serve you and to guide you along your path to retirement. So reach out if we could be of help to you. With that, I want to turn it back over to Riley. She's going to wrap up with just the last few announcements. I know there were a few questions in the Q&A, and we didn't get to all of them, so we'll reach out to you personally. Riley?
Thank you, Kaci. I'd like to thank Kaci Skidgel and Peter Reardon for their time in sharing this timely and valuable information with us today. And we would like to thank all of you for joining today's session. Join us in December for our quarterly webinar, Family Love Letters, where we will discuss how to leave your family a great gift that will take the pressure and stress out of a difficult life event. Please be sure to follow us on social media. And if you have any questions from today's session, or if you would like to be connected to a resource from Summit, please contact us via email at marketing@yoursummit.com. But for now, thank you so much for joining us and have a great rest of your day, and we'll see you next time.